This is the second of two sequential videos on problem 11-29. If you haven't watched the first video, you should do so first and then watch this one. This video starts at ratio number 8 on page F497. The asset turnover ratio is the first of the efficiency ratios that will be examined. This ratio divides net sales by average total assets. As the book says, it helps a company to see how efficiently they are using their assets to generate sales. The interesting thing about this ratio is that we have already looked at net sales, so those numbers are filled in, and we've already looked at average total assets, so those numbers are filled in. We have nothing to do on this particular ratio except look at the results. The 1.49 for year 2004 says that sales are 1.5 times the value of the assets of the company. In 03, the ratio was a little less, but I would take that as a good sign. Ratio number 9, the receivables turnover ratio, is another efficiency ratio. This time it compares average accounts receivable to the net sales. By doing so, the company can see how quickly they are collecting their receivables. Once again, the net sales is filled in from the prior ratio, and the average accounts receivable will need to be calculated. On page F496, the bottom line is accounts receivable. In the cell under average accounts receivable on the screen, the $2,340,000 from 04 and the $2,490,000 from 03 will be summed and divided by 2. In the next cell, the $2,490,000 from 03 and the $2,530,000 from 02 will be summed and divided by 2. The 6.15 result for 04 indicates that the company turns over its receivables a little over 6 times per year. In 03, it was a little over 5 times per year. That should be regarded as improvement. Inventory turnover ratio helps a company to see how efficiently its investment in inventory is being handled. Having too much inventory sitting on shelves can be very detrimental to a company's financial health. To calculate this ratio, the costs of goods sold is divided by the average inventory. The costs of goods sold is, of course, the second number on the income statement. So for 2004, its $10,213,000 is entered as $10,213. For 2003, its $8,761,000 is entered as $8,761. The average inventory is calculated in the same manner as the other averages, and the numbers needed are at the top of page F497. In the cell under average inventory, the formula for 04 is open paren 776 plus 693 close paren divided by 2. For 03, it's open paren 693 plus 520 close paren divided by 2. The end results of 13.90 indicates that the company uses all its inventory over 13 times per year. In 2003, the ratio was a little better. We now jump down a page on your screen and move into liquidity ratios. Liquidity is a picture of a company's health relating to the composition of its balance sheet. Each ratio measures a different aspect of the company's health and will indicate each as we go along. The first liquidity ratio is the current ratio. This should not be new since it was covered in the last chapter. The current ratio divides the current assets by the current liabilities and gives an indication of the results if the company closed down and had to use its current assets to pay all its current liabilities. In the cells under current assets, the numbers on the third line down on page F497 are entered. The top cell gets $5,556 and the one below it gets $5,279. The current liabilities are 6 more lines down on the same page and are $4,336 and $4,000 respectively. The results of 1.28 and 1.32 show that the company could liquidate all its current assets and pay all its current liabilities. The quick ratio is a more rigorous examination of a quick payoff of current liabilities. Instead of using all current assets, the quick ratio only uses cash, short-term investments, and current receivables in the numerator. This method eliminates items from the analysis that may be harder to liquidate, such as merchandise inventory, which would have to be sold, or prepaid expenses, which quite often cannot be recovered. As you can see in the book, cash on the bottom of page F496 is $2,240,000 for 2004 and $1,936,000 for 2003. The 04 cell under cash gets $2,240 and the 03 cell under cash gets $1,936. There are no short-term investments listed in the balance sheet, so those two cells are zeros, and the current receivables of $2,340,000 and $2,490,000 are entered as $2,340 and $2,490. This provides a more rigorous ratio of 1.06 in 04 and 1.11 in 03. The operating cash flow to the current debt ratio is the liquidity ratio that indicates whether the company generates enough cash from operating activities to meet its current obligations. To do so, the ratio uses the cash flow provided by operating activities, which is provided to us in the additional income section on page F497, and divides it by the average current liabilities. In the cell under cash provided by operating activities for 04, 1,041 is entered, and for 03, 914 is entered. For the average current liabilities, the formula for 04 would be open paren 4,336 plus 4,000 close paren divided by 2. The formula for 03 would be open paren 4,000 plus 3,843 close paren divided by 2. The results of 0.25 and 0.23 indicate that the company would only be able to cover 1/4 of its liabilities each year through its operations. This next ratio, the debt ratio, is the first of the solvency ratios. As the book indicates, solvency is the ability for a company to meet its long-term financial obligations. To examine this ratio, we'll need to jump down a page on your screen. The debt ratio is a simple one, dividing total liabilities by total assets. The total liabilities are on page F497, one line above the stockholders' equity. For the 04 ratio, the total liability will be entered as 6,336. Remember, that's the 6,336,000 divided by 1,000. For 03, the number is 5,600. Moving up 3 lines in the book, the total assets are entered on the form as 10,725 and 9,032. The 0.59 and 0.62 indicate that the liabilities only come up to about 60% of the assets. This may be good, this may be bad. Only comparing these ratios to industry averages will give a good answer to that question. The next solvency ratio is the debt-to-equity ratio. This is the flip side of the debt ratio. Instead of comparing liabilities to assets, this one compares liabilities to equity. Once again on the screen, the total liabilities have been carried down from the prior ratio. The total equity is on the line just above the last line on the balance sheets. So, 4,389 should be entered on the 04 line, and 3,432 should be entered on the 03 line. The end results for both years show around $1.50 of debt for each dollar of equity. The times interest earned ratio is a ratio that shows the company's ability to make its interest payments. To do so, it divides the earnings before interest and income taxes by interest expense. Both of these numbers are on the income statement, and in this case, on the line labeled operating income. For 04, the first cell should hold 789, and the cell below it should hold 1,150. The interest expense has been carried down from a prior ratio, and the results of 4.59 for 04 indicate that the company earned 4.5 times the interest payment in 2004. In 03, it was closer to 8.5 times. The final ratio, operating cash flow coverage, indicates the company's ability to cover its liabilities using net cash generated from its operating activities. It is calculated by dividing the average total liabilities into the cash provided by operating activities. The cash provided by operating activities has been carried forward from a prior ratio, and the average total liabilities is calculated by summing the beginning and ending liabilities for each year and dividing by 2. For the 04 line, the formula will be open paren 6,336 plus 5,600 close paren divided by 2. These numbers, of course, are on the total liabilities line of the balance sheet in the book. The formula for 03 is the same, except the 5,743 can be substituted for the 6,336 number. The ending results of 0.17 and 0.16 indicate that the operating cash flow would take a significant amount of time to pay off all the total liabilities.